Risk management is the most important part of trading. In this video, I'm going to show you how you can turn $5,000 into $60,000 without ever risking more than $50. Why does risk management matter? So trading is all about survival. You need to live to trade another day. And with a small account, this is even more true than if you have a large account where you can lose lots of money. Proper risk control helps control your emotions and prevents you from burning out and blowing up your account. So what's the golden rule of trading? You need to protect your capital before chasing profits. Think about this. If you have an account that's $5,000 and you lose 50% of it, just to get back to that original $5,000, you need to make 100% more. So it's important to manage your risk. Keep it small, stay consistent, and compound steadily. That is how you're going to turn that $5,000 into $60,000. So it's all about position sizing and managing risk. So the big thing is never risk more than 1 to 2% of your equity per trade. Usually I will probably put on about 0.5% to 1% and only 2% of my equity if it's the ideal setup. And it's important not to confuse your buying power and equity. A lot of brokers will give you a margin, usually 4 to 1. So let's say you have a $5,000 account, they may give you $20,000 at buying power. That doesn't mean that you can risk $200 because that's 1% of $20,000. No, you could still only risk $50. You could only risk 1% of your equity, not your buying power. And then what you have to do, the formula for deciding your position size is your risk per trade divided by the stop loss. So for example, if you had that $5,000 account and you want to risk 1% maximum, that's $50, and your stop loss was 25 cents, below your current entry, that would mean you could enter for 200 shares. So, we have to be able to do this very fast. So what I do is I create these tables like this. It's a sample risk to position size table for a $5,000 account. And so here I know based on where my stop is going to be, and I'm always going to put my stop at a very technical area that I expect there to be support. So I don't just put my stop loss wherever. I'm going to put it at a very specific spot. And I have to know how far that is away from my entry position. I'll say it's 10 cents away, 20 cents away, 30 cents away. And then I can just look at this chart and I'll print it off, and I know exactly how many shares I can buy to maintain my risk of 1%, 0.5%, 2%. I have this readily available. So if I say this, I'm going to buy Tesla, it's currently at $300, my risk is going to, or my stop loss is going to be $1 away, and I'm risking 1%, that means I can buy 50 shares. And I know that right away, just by looking at my chart, and I can very quickly put in my order. And that way I maintain that ability to only risk 1% of my account. And the next part is that stop loss. You always need to have it. If you don't have it, the stock could drop. You could think, it's always going to come back. You need that stop loss there to protect you and protect your account. So here's a few tips for your small accounts. First thing is focus on liquid assets. So these are, stocks in play, stocks that have a lot of transactions. They'll have a tight spread. I rarely trade anything that has more than a 2 or 3 cent spread. If I look at something like Meta, it has a 20 to 50 cent spread. I'm scared of that. I stay away. I'm going to stick with Nvidia, AMD, Tesla. 1 or 2 cent spreads. I don't need anything more. Those are very liquid. There's lots of people buying and selling them all the time. It's easy to get in. It's easy to get out. I don't have to worry about computing the spread as part of my, risk management. I keep it nice and tight. Next, you want to grow your account gradually. Don't force your trades. Don't worry about everything swinging for the fences every single time. Let it grow naturally. And you want to preserve your cash for high probability setups. That's why I said, usually I only risk 0.5%. But sometimes I'll see a perfect setup for me and I will go ahead and I'll risk the 2%. And now here's something to think about, and this is how you're going to grow that $5,000 trading account to $60,000 in only 1 year, very easily. You just have to gain 1% per day. So at the start, you're not aiming to make $300 a day. You want to just make $50 a day for your first few days. And as your account grows, that amount will go up because it compounds. But again, you're just focusing on making 1%. 1% per day will grow a $5,000 trading account to almost $60,000 in 1 year. And that's only with 250 trading days a year. So think about that. Don't swing for the fences. Gradually grow your account. 1% per day is an amazing trading day. So my closing quote is, successful trading is about managing risk, not predicting markets. All day trading is about is managing risk. It's not knowing what's going to happen, making the best trade ever. No, managing risk is all you need to do and all you need to understand to be a successful trader. If you found this video to be helpful, please give it a like and subscribe to the channel for more trading tips. Until then, keep it green.